Good afternoon, Artan. How are you today?
Very good, John.
Can you tell me more what you do?
Sure. What we do is we are a mortgage banker in the San Francisco Bay Area.
Okay, and what does mortgage banker does?
What a mortgage banker does here is that we make loans to people who want to buy a home. So there are three different areas or types of places that a home buyer or potential home buyer can go to get financing for their home. One would be a bank, a traditional Bank of America, or Wells Fargo, or Chase. Those big major institutions, they offer home loans. And what they do is they use the monies that they get from their depositors or the government, and they use that money and then they make a loan to the home buyer. The other place that a home buyer can get loans from is a mortgage banker like us, where we get a line of credit from banks, and so that we use that line of credit to make a loan to the home buyer, and then we sell that loan off to either a bank or Fannie Mae or Freddie Mac or to the government. And the third source is that there are mortgage brokers available who will essentially broker that loan to a mortgage banker like us, who we then sell off to Fannie Mae or Freddie Mac.
What is the opportunities in the mortgage banking business?
Well, right now the government has really created a very, very unique environment in the mortgage banking industry. They have brought interest rates down very, very low to spur the economy, and they're very much afraid of the U.S. economy going into a double-dip recession, or maybe even worse. So what they've done is they've stimulated the economy, doing everything they can, and the primary tool that they're using is lower interest rates. And what that has done is that it's spurred a tremendous refinancing opportunity, as well as it's spurred a lot more people to buy homes. And so I think we've seen a bottoming out of real estate prices, and people are getting pretty excited about buying homes right now. And so, we commonly see multiple offers, 5, 10, 20 offers on a particular property. So the opportunity in mortgage banking is that for a company like us, we obtain a line of credit essentially from a Chase or City Mortgage or Bank of America, Wells Fargo, or other types of lending facilities that will lend us $50 or $100 or $200 million as a line of credit, but we use that specifically for lending on a home. And so after we make the loan to the home buyer, we will aggregate these loans into pools of 10 or 20 or 50 million, and we will then sell them off to Fannie Mae, Freddie Mac, or to the government FHA centers. And they will then buy these loans from us. It then replenishes our warehouse lines, and then we continue to make more loans. What's very interesting about this particular format is that it really cuts down on risk. There's not really a huge amount of risk from our side as long as we make the correct loans, because Fannie Mae, Freddie Mac, FHA, they're buying the loans from us, so we're not taking any credit risk.
Okay.
So the opportunity is actually very fantastic.
Okay, so let's say an investor wants to go into the business of mortgage banking. What's the procedure?
Well, procedure-wise, of course, you have to set up the corporation to do it the right way. But for an investor, well, we're actually offering the opportunity for investors, or the opportunity to invest in us, where if we're able to get, well, essentially for every $1 million that we are able to get into our net worth, we're able to get an additional $20 million line of credit for lending on homes. So if we're able to get another $5 million to add into basically a savings account, a company like Wells Fargo, for example, will give us another $100 million in available credit to be able to lend to home buyers to make the loans. What that will allow us to do is to be able to lend more to to home buyers, because right now the vast majority of lenders are very, very busy. They can't lend fast enough, and so there's a huge demand for lending at this time. And so if we actually had a larger capacity, a larger warehouse line, we would be able to do more loans and be able to turn around our warehouse lines more and faster.
Is it easy to sell the loan once you have done the loan? For instance, you would sell it to Fannie Mae, or you sell it to the bank, or how does it work?
Well, for smaller mortgage bankers, which we were selling it to Bank of America, to Wells Fargo, to Chase, to Citi Mortgage. And it was okay at that time, but it presented a lot of challenges, because when we sold to them, they would then come back and say that they needed some additional documentation before they actually bought it from us. And that caused some delays at certain times. And so those delays would clog up the warehouse line, and then we wouldn't be able to free that up to make more loans. Now we've actually gotten to the position where we actually sell directly to Fannie Mae, and so we don't have to sell it to Bank of America or Wells Fargo, and so it's much faster to sell it to Fannie Mae, where it used to take maybe 15, 20, or even 30 days to sell it to Wells Fargo. We can sell it to Fannie Mae basically in 3 days.
3 days. Now, in order to, it has to be approved by Fannie Mae, obviously, if you want to sell directly to Fannie Mae, correct?
Well, our company is approved with Fannie Mae directly, so it took time for us to have at least 10,000 loans that we've actually done and sold to banks before Fannie Mae actually accepted us. And so now that we're accepted by Fannie Mae, we can sell directly to Fannie Mae. And so what Fannie Mae does is that they expect our loans to be approved correctly, and so they're just buying it from us. And so we don't have to wait for another approval before they buy it from us.
Can you explain what Fannie Mae is?
Sure. Well, Fannie Mae stands for a federal agency that buys mortgages. And so many years ago, around the 1930s, Fannie Mae was created actually at that time to help the country get out of a depression. They wanted to make mortgages more available, more liquid into the secondary market. And so it was a government entity, and then throughout the years it basically became a private organization. And so bottom line, what Fannie Mae does is that they provide an avenue for us to sell loans to, and then so they buy these loans, and then they then sell what we call mortgage-backed securities into the secondary market, Wall Street, basically the bond market in Wall Street. And so Fannie Mae will then buy loans from us, from Bank of America, from Wells Fargo, from basically, I would say 98% of all mortgage loans that are done that are $417,000 and less are sold to Fannie Mae, and they provide that liquidity for that market. And so after they buy it, they then sell those securities in the secondary market in Wall Street to raise the money to then have more money to then buy more, more mortgages from us.
I see. And also you can earn servicing the loan?
Yes. So we get paid when we sell the loan to Fannie Mae, and then we also get paid by Fannie Mae to service the loan. And what that means is that when we collect payments from them on a monthly basis, they also pay us some additional revenues for that.
Usually it's about how much?
It's usually about 0.25% a year.
0.25% a year, okay. Out of the interest amount or out of the loan amount?
Out of the loan amount.
Loan amount, okay. So let's say, one investor is interested to invest in mortgage banking or mortgage banker. First they have to open a corporation, and then they need the capital, obviously, right?
Correct.
And they need someone like you to get credit line from all these different lenders, correct? Or do you need a license, a special license? Or
you absolutely need a special license registered under the Department of Corporation, as well as the Consumer Finance Agency, and everybody has to be registered under this new license called the National Mortgage Licensing System that the federal government created a couple of years ago. And so it's a very heavily regulated industry. We're regulated pretty much like a bank, and everybody has to go through all kinds of background checks and FBI checks and things like that. But there's a lot of compliance things that the company needs to maintain in order to be able to run continuously. We've gone through all of that, and so right now we're funding approximately $130 to $150 million per month. So roughly $1.5 to $2 billion a year of loans is what we actually do. And so I think we've established a nice foundation and a little bit of a base. And I think we're really positioned well to begin our next growth phase.
Mm. And how many people do one need to hire in order to make the company successful in the beginning?
Well, the beginning question is a hard thing to answer because it depends on the size of what you call the beginning.
Let's say it's $5 million in investment.
Well, if we were to start a brand new company from scratch and we took in a $5 million investment, that would allow us to get a $100 million line of credit to make loans. So that would be a decent beginning stage to create a mortgage banking company. And we would probably need to hire roughly about 100 people.
100 people.
To be able to, to fund $100 million a month. Well, let me clarify that. If we got a $100 million warehouse line, we would try to turn that over twice a month.
I see.
So
let's go back.
Yeah.
Explain what warehouse line is.
Okay, so let's say Wells Fargo gives us a warehouse line of credit of $100 million. Now, we can't just go use that to buy a plane or a boat or anything like that. That money is specifically set to lend on mortgages, and so it can only be lent on mortgages. So a home buyer buys a $500,000 home, they put $100,000 down payment, and they borrow $400,000. They submit an application to us, we review it, we then decide whether or not to approve it, and if so, then we will lend that individual $400,000. So that'll be one loan, and then we'll do that for this person, this person, this person. So 400,000, 10 loans, that's 4 million, 100 loans, that's 40 million. And so 200 loans, that's $80 million. So pretty much 250 loans would be the maximum we would be able to lend on this $100 million line.
Yeah.
But once we make the loan, then we're looking to be able to complete the finishing touches on it and be able to sell that off to Fannie Mae as soon as possible. So hopefully we will be able to get that turned around in as quickly as maybe 7 days in a week, maybe no more than 2 weeks. So we will estimate no more than 2 weeks, and so therefore this $100 million line, if we're able to turn it over twice a month, basically, it would allow us the capacity to make up to about $200 million worth of loans.
I see. And per loan, we probably earn how much for the company?
The gross profits on that will be approximately 1.5% to maybe 2%.
1.5% to 2% per loan. So it's a $1 million loan. We're looking at probably 15 or 20,000, approximately.
Correct.
Right. Okay. All right. Is there anything else you'd like to add?
So on 100 million, we're looking at about maybe $1.5 to $2 million of gross revenues, and then we would then have to pay those expenses.
Right.
And the remainder would be our profit.
Okay. Excellent. Okay, Arton, thank you very much for your time. Appreciate for giving us information about mortgage banking.
You're quite
Thank you.
welcome. Thank you.